All right, welcome back to another episode of the e-commerce playbook podcast. Today we have another podcast star joining us as a guest as well as a regular recurring. Dave, I think you've been here before, right?
Sure. Yeah.
You've been here before? Yeah, Dave's a regular. So we got an exciting episode. We're talking ROIC today. Dive in, put on your financial hats, get out your bean counters. We're going to dive in right now.
Hey everyone, before we get into the episode, I wanted to make a quick announcement. If your brand is doing $10 to $100 million in annual e-commerce revenue, CTC wants to work with you. And here's the kicker. If we evaluate your brand and its GQ score is 130 or more, we're so confident that we can win for you that your first month with us will be absolutely free. So just head over to commonthreadco.com, click the Hire Us button to get started, and then just let us know in the contact form that you want to be evaluated, and we'll be in touch. All right, on to the show.
Right, special guest today, all the way from another one of the popular podcasts in our industry. Mike, I was just listening to you in the car, and now I get to come over here and get you in person. Mike Beckham from Simple Modern. You all know him well, but Mike, you want to give the people who haven't had a chance to listen to you on the Operators podcast a little bit about who you are and what you do?
Sure. A little bit atypical. Been out of college for 20 years, 10 years in the nonprofit world, 10 years basically running e-commerce businesses. The first one was one that I built with my brother that got to about $1 billion in revenue over a 7-year period. And then founded Simple Modern in 2015 with a couple of close friends of mine. And we've grown that to be a 9-figure business during that period. And so love talking e-com. Can't believe I have not been on a podcast with you to this point, Taylor. So I'm excited.
I got to say, so Mike, I don't know, it was probably like 2 years ago, you and I got on a call. Now it's been a while.
Yep.
And at that point, I would say Simple Modern in the social D2C sphere was like, you guys hadn't made your appearance yet. But right. It turns out, for those of you that don't know, Mike is like the wise mentor advisor to like all of us. Like he's like the guy that everybody goes to, and he has just exploded onto the scene, but he's been there all along, just so that advising a lot of the people in e-commerce in a way that he's always incredibly gracious with his time and his wisdom, and his team is awesome. So excited to have him here for the first time, Mike. It is long overdue. And of course, we've got Dave Rekuc. You guys all know him really well. He is the president of Bambu Earth and my children's retirement plan. So Dave, you want to give the people a little bit about yourself too?
Yeah, absolutely. Before becoming the steward of your children's retirement plan, I was in e-com for about 15 years, did a little bit of time on the brand side, spent about a decade on the agency side. So I've worked with a really wide variety of brands, mostly in marketing. I came into 4x400 in 2020. I was on the marketing side and in charge of the new brands. And when we decided to narrow our focus on Bambu Earth, went all in on that and then wound up leading Bambu Earth the last year and a half.
Awesome. Well, so here's what we're here to talk about today. This is why these gentlemen have joined me, is because I was lurking on their Twitter conversation where they were having a dialogue about how to think about the obligation that a founder or a steward of capital, as CEOs are often referred to, in terms of how they're thinking about making investments and how they obligate and measure the return on those investments. So we're here to talk about a principle called ROIC, return on invested capital, which is a fancy formula that, to the best of my knowledge, and I heard this once, maybe you can confirm this, Mike, but Bill Gurley took credit for this on a podcast I listened to him the other day, that this was a mechanism that they developed for finding another way to analyze public companies and try and find sort of value arbitrage. And the formula is NOPAT, net operating profit after taxes, over invested capital inclusive of the cost of that capital. And it's just a way to say, is a company finding a way to deploy money and get a good return on it? And they used it. Is that your understanding of where this came from? Am I right on that?
I have no idea if Bill Gurley came up with it. I feel like it's a little bit like Austin Powers, where he says, I made outrageous claims like I invented the question mark. I don't know that Bill Gurley invented the idea, but yeah, like that's the general gist. I think that's a good description.
Okay. Dave, you can clarify that. You're a history.
Yeah, as far as I'm concerned, it's invented by Investopedia when I was going down a rabbit hole, just trying to learn as much as I could about this sort of thing. And that's where I first heard the term. And since then, it's been pretty popular in the, capital allocation type circles where people talk about exactly this, allocating capital inside businesses.
The easiest thing I think to use here, just for everybody listening, is return on invested capital is a report card for how good a job is a management team doing of investing resources back in a business. And the reason why that's important is because it has a lot of implications for the type of debt structure that a company should use and where excess cash flows go, whether they stay within a company or if the company's in a place in its life cycle where they should be distributed to shareholders in one form or another.
Yeah, that's right. So we are deviating. I think a lot of our conversations on the e-commerce playbook podcast sort of orient around tactics that are about driving value capture for today. And now we're going to sort of assume that we've done a pretty good job at it for a little bit as a group, as an audience here, and with two guys who have done it pretty well for a while. And what that now affords them is a new challenge. And that new challenge is to be a steward of the treasury, to decide, okay, we have extra cash on our balance sheet and I have a choice to make. Am I going to just give it back to the shareholders because I don't have a capacity to generate a return on it? Or does my business offer me a vehicle to generate a better than market return or better than, whatever the expectation of the shareholders level is of return? And if so, how do I make sure that I'm diligent about that and thoughtful about it? So maybe, Dave, if you want to set up, what were you thinking about? What was the conversation you started having with Mike? And tell us a little bit about the position of Bambu Earth and what prompted you to start thinking this way. And then Mike, we'll kick it to you for how Simple Modern has done this.
Yeah, definitely. So what I was thinking about, I tweeted this out as just sort of a question because it's something that I haven't had, as you put, Taylor, I haven't had the need to encounter significantly yet. I haven't had the need for a rigorous framework yet. But Bambu Earth is now in a position where it's generated over 7 figures of cash that are sitting on its balance sheet. And now we're also in a position where we're a low 8-figure brand. And we've been through a lot of the optimizations that are the low-hanging fruit. They're going to produce the year-over-year significant gains. So now I'm starting to think about, okay, 2024, 2025, how do I continue to push the substantial growth, 50% year-over-year type categories? And the truth is that I need to build a foundation that is going to drive that, not just stay in my own bubble, stay in the own kind of set of rules that have been applied for me, but to be able to invest in new things that are going to be able to change the ground rules to growth. And so one fear I have that's lurking in the back of my mind is in 4x400, we went through a period of time, we were pretty public about this. We went through a period of time where we continually produced overly optimistic projections especially for our new brands. And at the time I was VP of new brands, so I felt that rather acutely. So we were overly optimistic with those projections. And the thing that helped me change, on top of Taylor coming in with a different perspective and saying, you're being way too optimistic with this, like, let's put together a real projection, hit it, and be responsible for it, is I also went and not only did monthly projections where we build them up with cohorts, but I've talked about this before. I wound up doing 4 projections for every single week, a 20th, 40th, 60th, and 80th percentile. And then I tracked those on how often they were realized and related them back to how often they should be realized. An 80th percentile projection should only happen 20% of the time, right? And so this means I literally made hundreds of projections and got way, way better at it. What you measure, you manage. So now presented with this new challenge where I'm going to start allocating significant amount of money to build the foundation that Taylor's kids are banking on me for, right? So I want to do this in the most responsible way I know. I want to create a framework that creates responsibility that not only says, does this pass the bar of distribute to shareholders versus reinvest in company, but am I choosing the correct bets? Am I choosing the correct ventures for us? Am I being overly risky, under risky, et cetera? And so I knew there are a lot of operators who are smarter and further along the journey than I am. And so I freaking tagged every one of them. And Mike started to speak up. And I think that's a good segue into Mike's experience with this.
Yeah. So Mike, you are further along and had to think about this a lot. And so I'd be curious, what frameworks do you have? How do you approach this problem? And how should Dave begin thinking about this?
Okay, so I'll just start at the top and kind of work through my logic tree. The first is the business in a place where it can continue to make, outperforming investments? You have to kind of start there if you're generating excess free cash flow. And one of the reasons I say that is my brother and I ran a business at one point where we generated mountains of excess free cash flow. And we made the massive mistake of plowing it all back into the business when we really didn't have great ways to plow it back in the business. I mean, I have set wheelbarrows full of money on fire doing that. And if we had just pulled that money out of the business and put it in the stock market in 2009, 2010, we would have had way more money. And so it is very tempting when you're an operator who has been successful to just believe that you can do better with money than, than somebody else can, or by pulling it out. It's not always the case. And I think it takes a real level of humility and self-honesty to be able to evaluate your business and evaluate your prospects. Also, I think it's worth asking, do you have highly complementary ways you can invest that money in the business? Because if we're running a drinkware company and I start using excess free cash flow to buy oil derricks, it's like, even if it's a good investment, like that's probably not how I should be doing it. That money should come out of the company. There should be a different LLC. And so you'll see that sometimes where people just lose focus and they become kind of this, Frankenstein. So what we're going to do in this conversation is assume that you do have prospects within, and like one thing is we're saying one of the reasons why it is so advantageous to keep capital in a company and reinvesting is that you don't have, there's a lot of tax consequences a lot of times when you pull money out. And so there's some advantages to keeping it in. Let's just assume that you do have that. And I want to walk through the way that I think about it, like the framework and how we apply it, and then we can just kind of riff on that. However,
Can real fast though, before you do it, there's two terms that you said in there that I just want to make sure I understand and think about
Sure.
the threshold for. One was this idea of excess free cash flow. So this is a question of working capital necessities and how that relates. Like, what is the point at which you reach excess, and how do each of you maybe briefly think about that moment? Like, where is it like, no, this is not my operating working capital for the next 12-month forecast? Is there some period of time where you've done a cash flow forecast and you have a sense that you're now above and beyond some threshold? Like, what does excess mean?
So Dave, one of the things Dave said that I really liked when he talked about his 20, 40, 60, 80, it actually, we sell directly to Amazon. We're a 1P vendor, and that's how they do all their forecasting. It's actually on a confidence interval where they'll give you several different probability curves. And I do think you have to run your business with enough cushion where if you miss forecast by 15 or 20%, it's not an existential event for the company, right? Like, we're not going to make payroll if we don't. And so the other piece with excess free cash flow is that if your core business is growing organically, then you're going to need to buy more inventory and more things to fund that. And I don't really think about that as like new investment. So like what we're going to talk about today, I'm not including like, hey, like literally here in 30 minutes, we've got people giving a line review to Target. They're going to pitch some additional facings. Target's going to order that. That would require us to carry more inventory. I don't really think about that as investment because it's so straightforward, but that does require more working capital. And so that eats into even, that takes a chunk out of your cash flow, and it reduces, free, what I would call investable cash flow. So when I think about investable cash flow, where I would start is, okay, first, what's your kind of EBITDA or your taxable income? You're backing out taxes. You're backing out any kind of obligations you have to shareholders. So I've made some agreements with my shareholders that, hey, I'm going to get a certain amount of money out of the company. We're going to do a certain amount of stock buybacks and redemptions. So those two things come off. And then we're taking off any money that's just organic growth. Hey, Amazon, we think Amazon's up whatever percent next year. We need this much more in inventory to be able to support that. And that number, that's where I start with thinking of like, okay, this is the pot of money that can be reinvested across the business in what I would call more speculative growth investments. And so the way that, so if, does that all make sense? I guess we'll start there.
Yeah. So let me see if I could say it back to you so the investable free cash or excess cash is going to be net of your working capital, whatever you determine that to be, net of your obligation to shareholders that you have in your agreements, net of taxes, and sort of that delta of what's there now that gives you start to think about your piggy bank. Like, that's what I have to invest here. Yep. So Dave, is that similar to sort of how you're processing this?
Yeah. So the one other thing that I consider a little bit, because we're still a little bit younger on the growth curve, is that we actually have very lean working capital, but there's actually ways that I can trade cash or working capital for profit. And so like that increased working capital absorption, if I have that on the roadmap, I've also got to carve that out from investable cash. Like a good example is like we're just this week splitting our inventory by coastal, and it's going to save us a bunch of money shipping, but it means that generally you have to carry a little bit more inventory in order to be able to do that. So there's a little bit of cash that goes and gets reabsorbed back into the business, but on an accrual basis, your bottom line improves over time. Even on a cash basis, it's great ROIC, but that's something that you've got to carve out and make sure that you're not touching that increase of cash with your
And so similar to Mike, you wouldn't actually consider that an investment activity in the category of what we're talking about because it reflects the core function of the existing business?
I actually, in this case, because it's so like what I believe Mike is referring to is like the typical working capital absorption of just 50% year-over-year growth, right? Like, so my working capital absorption rate is this, and therefore I'm going to need X in inventory just to service this growth. That I would not. And that's an operating function. I'm staying within the parameters. But if I'm intentionally changing the working capital absorption rate and I'm intentionally incurring new levels of working capital, I actually would be looking at that as a bet. It's an operational bet, so it has a higher level of confidence compared to like a more speculative marketing bet. And that's how I would treat like assigning a confidence level to it. Is how I would treat the difference there.
Okay, great. So Mike, now we have a sense of what do we have to invest and how do we get to a thoughtful process around that. I'm curious, are you going to go into sort of, you started to touch on this idea of hurdle rate. Like what's the necessary? Are you going to dive into that more in this? Okay,
absolutely.
Great.
Absolutely. So, okay, I'm going to just kind of rapid fire a few principles that I think are important. Number one, your goal is the highest risk adjusted rate of return. And we can come back to that. But Dave just mentioned this. There are some things where it's like, hey, I feel 95% confident that if I split my inventory on two coasts, that I'm going to be able to recognize these savings. And so the savings, my return on that additional inventory to go by coastal is 30%, which is not as high as a lot of my other investment opportunities, but my risk ratio is so low, right? On the other extreme of things, launching a new product is among the most risky things you can do, but the potential return is so massive and so asymmetric that it still has a great risk adjusted return. So the way that I think about it with our business, one of the things that scale has allowed is that we have a lot of these. We probably, in a given year, if I really broke it down, 30, 40, 50, 100 different ways we're investing capital, and each of them sit in a different place on this kind of risk reward spectrum. But the goal is that, to your point, Taylor, first, I have a sense of what is kind of the hurdle rate of what I want to be hitting. I actually think that hurdle rate is not particularly outrageous. I mean, is it in the 20s? Is it in the 30s? Is it low 40s? I don't know, but it's not an outrageous number. I think if you feel like, hey, I can invest money and hit a 30% internal rate of return and consistently do that, you should be doing that.
No shareholder is going to be upset with that return on their money, right? Like
absolutely.
Is that why you say that? Is because you're thinking about a comp to the market or the alternative investment opportunities? Like why do you say it doesn't need to be that high?
Well, yes, because I mean, where's the money going to go? Like, I don't know on 100% of the company, but like, let's just say that I owned 100% of my company. It's like, okay, so I'm not going to invest it in the company. Well, where's it going? Is it going in a bank account that's earning 5%? Is it going in an index fund that I think might hit 8%? It's got to go somewhere. So if those are the alternatives, then like, yeah, 30% internally looks amazing to me, or 25% even maybe looks really amazing to me.
Mike, so I'm sorry.
Interestingly,
do you mind if I stop you for a second? Because two quick clarifications. One, in the example that you gave where you are the sole owner and you're pulling it out, first of all, that's post-tax. Yeah. So like you have to factor that, right? So like a lot of what we're talking about here, you can either fully expense or aggressively amortize if it's CapEx, and write off a good portion of those investments. So that lowers the bar further in terms of the marginal that's necessary. And then the second question I had was actually just quick clarification. Is when you say like a 30% return, is that already risk adjusted? Like, so if you're saying, hey, we're introducing a new product, 30% chance of a hit, but it's got 100% return on the investment. Therefore, it's I'm risk adjusting that. And that's a 30% expected return. If I could go do this 100 times, that's what I'll essentially realize.
Yeah, it's always difficult for me to your point earlier, Dave, to really know fully what the risk adjusted return of a particular thing is. And so instead, the way that I think about all this stuff is portfolios. Okay. that what I want to do is make a multitude of bets where there's a really credible, either there's very low risk and there's a credible return profile, for example, your bicoastal example, or where there's a really incredible return profile possible, even if I can't assess the possibility that we hit that. Like this product, if it works, could produce, $20 million in top line. Is it a 25% chance that it gets there for us? Is it a 15%? I don't know. But if over time I see a track record with my management of being able to make that portfolio blend out in a good place, then I have confidence. And so a lot of my confidence doesn't come necessarily from feeling like, oh, I know the numbers exactly on this particular thing. It comes more from, with this management team doing these type of activities, when you aggregate several bets, the numbers historically have said we hit really good numbers, and I can feel a pretty good level of confidence. And one other thing that's worth saying, when you run a consumer brand, your risk profile keeps going down. And this is another, like when we launch drinkware, it sells. Like our risk, and this is an interesting thing about product. I'll get into like talking about the different kind of hierarchies and how I think about them. But to my knowledge, we have never lost money on a drinkware buy in the history of the company.
That's a nice track record.
Because at the worst, we dump it and basically break even. And so one of the analogies that I'll give with people sometimes, imagine you could go to Vegas with $10,000 and you could play blackjack, and when you busted, you just got your chips back. And but then when you won or you hit 21, you still got paid out. And that's kind of been our experience with product development, which has made it a lot easier to not have to be as dialed in on my risk adjusted return, because we just haven't had those negative 100s, negative 70s in the kind of historical data.
Right. And because the larger your customer base gets, the lower the take rate needs to be to pay it back. Right. So like that's part of the
and built-in distribution. Like, cause that's what a lot of what Mike has is the built-in retail distribution, especially drinkware. Like I'm going to bring this to the target buyer, the whatever buyer, and they're going to pick it up for at least some portion of distribution. So quick question, because the feedback loop is incredibly important to me. So like you're obviously further along, you've been able to make a significant number of bets in same category as well as category expansion. So it sounds as though you're using, whether you're kind of intentional with this labeling or not, kind of low risk, medium risk, high risk, like rather large categories, so to speak. And then just saying, I'm going to track these similar bets over time to be sure that the upside is measuring out with the cost for this bet. Is that vaguely correct for how you're kind of answering to that?
Yeah. So I'll give you my kind of categories. I would say the first category is, where can I potentially speculatively invest more money in existing products and inventory where I think I could produce growth? For example, hey, we've been selling this water bottle. We've been selling it with 10 colors. We think color number 11, 12, and 13 are going to be incremental, but not crazy incremental. But also my risk profile is almost zero. Like the product's de-risked. I know the reviews, the distribution's established. I just have to buy the inventory. So like that's the easiest. And it probably should be the first tier of anytime you can do something like that leverages everything the business is doing, but you're just putting a little bit more capital towards it. That probably comes first. Then the next tier for me is new product expansion. I would probably break that into a couple of sub tiers where it's like new product drinkware expansion is the number two thing we can put money in. And we want to put as much money in that as we probably can credibly. And then I think, like you said, we've gotten into some other things. We've had some good success recently getting into things like textiles and bags, so things that are outside of our core brand demographic and footprint. Those kind of product expansion opportunities would probably be next. And then I think investments in CapEx, investment in team acquisitions, investment in marketing that's not as performance driven. These are all things that are falling probably further down my funnel.
Okay, so bringing it back, I have a question about product, because I think this is like an obvious one for people. And I'm curious about how we think about the return profile of a new product, because you mentioned that it's highly risky. And I think I've always, like Kayla, we used to talk about this a lot. There's sort of two core actions in my head that we would think of when we thought about product category. One was like an LTV expansion. It was like, we have an existing set of customers. What do they love? What's a natural sort of additional thing that we continue to think that we're going to sell rings, but we can extract more out of every customer by also selling them X, Y, or Z. And then there's sort of stuff that we think of as new customer acquisition, which is like audience expansion. We're actually trying to enter into a new category of people. And that one's like way harder to actually map in terms of what the anticipated return is. So like what is the process for each of you? I'd be curious about thinking about a product. And Dave or Mike, you mentioned drinkware, which is sort of maybe that's more like a colorway expansion or even just a styling expansion that you could probably do some really clear estimations in that. But how do you think about bags? Like that to me was an interesting one from you guys. And what was the modeling process? And then two, how right were you? I'd be curious. And then Dave, what are you thinking about?
Yeah. You want to go first or me, Dave?
Go ahead, Mike.
I've got a dog.
Well, I think that when we get into something that's truly outside of our footprint, the upside is so enormous, potentially. I mean, it is tens of millions of dollars in revenue. And an initial order, it's rare that we buy more than $100,000 or $200,000 worth of product on an initial order. Occasionally, we'll get up into the high six figures. I don't know that we've ever launched a product like an initial order that's been more than $1 million. We will probably need to, but we haven't yet. And so when you just think about it, like, gosh, I'm putting $500,000, $600,000, $700,000 at play. And I feel like my worst case is I can probably get out pretty close to getting my capital back if I have to. But my upside is potentially creating recurring revenue of millions or tens of millions of dollars. It's so asymmetric. And this is kind of the point that I make all the time. It's so asymmetric that it overwhelms the math. And, Buffett has famously said, like, people have asked him, like, what about your models, your numbers? And he's like, if I have to model it out, if I can't, like, on the back of the napkin, make it obvious, we don't do it. And I kind of feel the same way about product expansion, where I think the biggest key is that I'm looking at, is there enough product market fit in general out there already? And is there enough market demand that if we were to be successful, this can be a material contributor for us? And if it is, if I think we've got a good product and it can be a material contributor for us based on like what I'm seeing out in the market, if it hits, I actually don't have to go too much deeper than that. So like when we got into tote bags, our customers were saying they wanted tote bags. And I will step back and say here, one of the ways that I build my confidence profiles, we do a lot of internal surveying. We do a lot of talking to customers. But our customers basically told us this is the tote bag we want. So we went and built that tote bag. And I think that based on the early launch data and stuff, it's probably somewhere between a $5 and $10 million product line for us next year, which is fantastic. We bought $250,000 in inventory. And so that's I don't know, like, what is that? A 20X? Who knows? When you do the discounted cash flows, it's probably more like 100X. So fortunately, our experience has been that it's so asymmetric that the math doesn't matter. It really becomes more questions of, do you feel proud to associate this with your brand? Because for us, maybe the downside at this point, Taylor, is more harming the brand than it is the particular economics of that investment. Right? Like, I'm just not going to get burned. But if we launched a tote bag and a couple toddlers like hurt themselves on it, or, God forbid, something worse than that,
like a treadmill, maybe that.
Right. Yeah. Well, Yeti just had a $140 million recall because they use magnets and stuff. And those magnets, anytime you use magnets, if kids get those in their mouth, it can just rip up their intestines and stuff. And so interesting, like the risk adjusted return becomes less about, hey, what's out there, and it becomes more about your kind of brand management and product quality and recalls. You start thinking about some of that stuff more. So our experience has been that what product launching is very asymmetric, and that's been true basically since the beginning. So I'll make a point here that's really relevant to where we are as a company. We've been undercapitalized all the way through, and it's built this muscle. I think you tweeted something about this recently, Taylor, and I've had a similar thought. The great thing about being undercapitalized is it's like being hungry. It really focuses and clarifies what is the best thing that you can be spending your money on in a way that when you have abundance, you can't do it at the same level. The problem that and I use problem loosely. It's like first world problems, but we need to transition as an organization from kind of a scarcity mindset where it's like we have this limited amount of resources and we need to line up all the things we could invest in and compare them to each other, and survival of the fittest, only invest in the top 20%. Now we're in this situation where I don't know that we can reinvest all of the capital that we have. I don't know that we have enough ideas to get it all back in the company. And so I'm having to kind of rewire people. And some of these conversations that, like when you're talking about hurdle rate and some of this is coming back to the surface because now there's a lot more cash to invest. And I've built a team that's been really good at saying, here's the top 5% of ideas. Here's the top 10% of ideas. And now I'm coming to them and saying, hey, I need you to now try and get it all at play. And one of the reasons is, I think historically, if you said, hey, what's been our return on invested capital? It's something triple digits. And you can kind of understand it has to be, if we started with $200,000 and now, we're selling $170 million a year, there has to have been just this phenomenal capital appreciation that's happened inside the company. But it's actually becoming unhelpful that my company has this history and legacy of like, we hit triple digits when we invest money, because my point to them is, if you can invest $40 million at a 50% return on invested capital, that's way better than $10 million at 150, right? And so anyway, so those are some of the things that we're wrestling with, but for sure the product, we have a huge bias towards investing in product and product launches because of the asymmetric nature.
So Dave, Win Cosmetics.
Yeah.
What are we waiting for? What are we doing?
Well, so interestingly, similarly, we have as I started to dig into this with product development, we have a similar asymmetrical setup. And part of that actually is because we own the production. So like when Mike was throwing out numbers of what it takes to invest in a product, for us, it's a tenth of that. Like we can bring something to market for it. Really, it's the formulation, images, and like get the one-time work to essentially get it done. As long as we're not introducing an FDA regulated product that has to go through longer, like for instance, sunscreen and SPF moisturizers are on the table. Those chickens. Those are larger bets, obviously, because of the time and resources necessary. But we could certainly for $20,000, $30,000 bring something to market. And because of the fact that we own that production, the likelihood that we can't get rid of that inventory at cost is effectively zero. Like that is true. Will we recoup the $20,000, $30,000 invested in the product development? That's the question mark. But the inventory, you're going to clear that out for sure. We actually have a bigger risk of cannibalizing because Mike's in a world where introducing colorways or SKUs adds some level of preference capture and some level of preference shuffling. So where you just introduced red, they would have bought blue, but now they're going to buy red. But some of them, some new incremental customers will buy red because it didn't exist before. For us, we can actually, we're mostly solving a problem. We're mostly solving an issue that somebody has, that they either have acne or oily skin or aging or whatever it might be. And so if we're solving that problem well enough with a given product and we introduce a second product that is cannibalizing that, all we've done is bloat our inventory. Even if I move it, it's not adding new marginal profit for us, even if I move it. So there's a few SKUs. And what made me think of this is like, we had 4 products launch about a year and a half ago. I'm probably going to kill 2 of the SKUs because I believe all it's done is cannibalize. And all it's done is essentially bloat our inventory. And what I want to look for is how do we do some more of that opens up new pipes that we can advertise on for Meta, for acquisition, to bring in new customers, cross-sell to existing customers. So I actually wanted to have both those characteristics you talked about, Taylor. I want to cross-sell for LTV, and I want to also use it for acquisition there.
Yeah,
it's a great point, Dave. I will just say this. It's the reason why you can't evaluate an investment just on how that investment does. You have to take it in the context of the larger portfolio. There've been a lot of times where it's like, oh, this color is the new hot color, and we release it. And yeah, it sells really well. But then you look and it's just like, oh, it's cannibalized the crap out of these 3 other colors. We're not money ahead. And so I think the word you just said, it's incrementality. When you're investing money, you're trying to create incremental top line, incremental bottom line. And that can be challenging because it is so tempting to invest money where you're great, right? But that's also the place that you're most likely to cannibalize yourself.
And I also would add just one more point to this. Is like you said, if Buffett said, if you had to do the math or you had to do a model, it's a no, right? So if it's not an obviously yes, it's a no. And I think that the same rule should apply when looking at the returns to an investment. If it's not obviously producing returns for you, it's a no, and go find something that obviously is producing returns for you. If you have to dig that deep, it's not. Or it's not above the bar for where you should be focusing your time and energy as an org.
Yeah, or you're likely to sort of create some maybe fudge information for yourself to validate it in some way. It should be obvious. But so there's a really interesting thing here. So we worked with Colourpop for a long time. Okay, so Colourpop has a subsidiary, a giant subsidiary of Seed Beauty, who also is the manufacturer and producer for Kylie Cosmetics. And we went to their offices, and they do all of their production in a giant warehouse in Oxnard, California, and up north in Santa Barbara. And so they have a lab and their production facilities on site. And so what they've done is they've lowered, and Dave, this is something you referenced with Bambu Earth that I think is an interesting investment premise, which is that they've lowered the risk adjusted investment requirement of every product that they make, because they can instantly create it and have it on the site in 24 hours in small samples to determine the demand to then develop the production. And so they would say like, hey, we could be sitting here, we could watch a product pop off on Sephora.com and we could have it on our website in 48 hours. And that's our superpower. It's like, so product development, we just do exactly whatever happens on trend. And we're immediately in market with it right now. And so we never lose. Like, so the risk of every new incremental profit or product is like zero. It's like none, no risk. And so by investing in that underlying system, you actually improve the profile of every future investment ever. And so it's like an interesting, like, compounded versus a one-off investment. No. This underlying architecture actually improves the investment profile of every bet we make in product going forward.
It's underrated that you could adjust either side and get better returns, reduce risk or increase upside. Everybody focuses on the upside only. Reducing risk, as you just put it, or driving it almost to the ground into zero, is a great way to produce phenomenal returns.
Mm-hmm. The one example that we do laser engraving, and we recently bought a UV printer where we can do things on demand. And what's especially interesting about that is that the trend from my point of view, and this fits really well with Colourpop, is the more you get towards trend and the more you get towards individualized, personalized, the more people are happy to pay a lot more. And there's just way more contribution margin dollars to go around. Like we had, it's funny, we had personalization on, like laser engraving, a couple of years ago, and then we wanted to move the facility and change everything up. And so we turned it off for about a year. We turned it back on this spring. I think we started at $5. And then we were kind of getting overwhelmed. So we took it to 10. And then somebody popped off on TikTok, and we had one that had hundreds of thousands of likes. I think we sold in one day like 10,000 personalized units or something. And so we took it up to $15, and we just haven't brought it back down. But people are still more than happy to pay it. And so like that's become kind of our standard, is like, hey, it's $15 for personalized. And it's like, man, that is wild. Some people are buying units where they're paying almost as much for the personalization as they are for the actual water bottle. But to your point, Taylor, and I guess you can kind of nest this a lot of times. It's either investments in inventory or it's investments in CapEx. We had to buy all those lasers, but that's the gift that keeps on giving.
For sure.
Well, and on your P&L, it's just the realization of the value relative to the cost, because you're capitalizing that machinery, is just fantastic, right? Like there's just, depending on the game you're trying to play in whatever window, those kinds of things. And we had a similar thing at Kalo, where what happened was, there basically, as our CAC continued to rise, when we introduced laser engraving, it basically supported the entire next tranche of customer acquisition by creating that additional $4 in margin or whatever that allowed us to continue growth. Was all built on that. And because the machinery was so quickly, you could either rent it or you could pay it off and capitalize it pretty quickly. It was like just so much pure margin creation so fast. Now there's some labor and other things there too, but that's a really interesting one for sure.
For sure. One other point, this is probably more of a digital crowd listening to this, but it's a point worth making. that one of the easier ways for us at this point to add distribution is to get into an additional retailer or a different spot in a current retailer. And so it's not just, hey, what can we put money behind, in digital spend, but we're also thinking about, hey, what's a product that maybe gets us in with a different buyer, or, sometimes we'll have buyers come to us and say, hey, if you will do this, we will buy it from you. And that de-risks an investment in a unique way also.
I love it. All right, well, let's do this. We've been going deep. This is great, Mike. Dave, let's put you under the microscope here. Let's see if we can't take one of your investment theses that you're playing around with. Like, what are you thinking about? And maybe Mike can provide you poke some holes or some thoughts or give you the green light, and I'll do my best to just sort of sit back and see what we can do here. So what are you thinking about?
So one thing I've always thought about is we're in skincare, and we're primarily face. We're basically selling a routine for your face. And that's the main thing that we've done thus far. But what was interesting is that when we acquired the business, it came over with a little bit of a wider suite of products. It sort of dabbles in body, and to the point where it's very difficult for us to build a funnel to a bar of soap that costs $12. It just doesn't work. Right. So what I'm interested in doing is replicating some of our success that we have on face in some either body or in shower. And I ran an analysis on our SKUs that said, what is the same unique repeat rate on the same item? So item to item. So cactus concentrate. They tried the cactus concentrate in a bundle, on a mini, doesn't matter, and came back and purchased it in some way. That leads the pack. But I found that two of our bars that are used in the shower are among the highest unique repeat rate on the item. And they're right up there with our face SKUs. But again, I feel like we're missing sort of a well-rounded shower kit type product. And I was looking to invest in bringing in, a wet shampoo and conditioner, or a shampoo bar and conditioner into that to make a total shower kit that I can now drive a funnel to and start to sell. So that's an example of something where it's a category slight sidestep, and I'm looking to create the acquisition as well as sell to my existing customers on that.
Mike, what do you think? What questions would you have?
I mean, it seems plausible. Friends with Jeremy Thermswell, who, he and his wife run Kitsch, and I know that the dry bar, the shampoo bars and stuff like that has been a home run for them. So, I mean, it sounds plausible. How much I guess here's a question for you, Dave. How much is it, I want to watch behavior, and how much of it is, I want to talk to customers and hear qualitatively what they're saying? How do you balance?
So we really have not been a company that is habitually creating product. For the majority of the time that we acquired Bambu Earth, the product set that we acquired it with was essentially the product set until a year and a half ago. We introduced 4 products. So this is not a business that has the muscles built for routinely introducing products. But what I'm doing today is I'm looking to create a list of products that I think make sense from a category expansion, because they create an acquisition, they create a cross sell. Then I'm going to go survey my customers about it. I have a 500,000 emails that I can ask about this, or if they're interested in this type of product from us. I don't really believe in price point surveying very much. I'd be curious if you do that at all. But I can go ask them and get back a level of interest, or even make them rank a variety of different products for me.
Yeah, I mean, my experience has been that when we ask our customers what they want, and when we really listen to them, we just have not we've not gotten caught off guard by the response on launches. And on your price point thing, I don't know that I'm as big a believer in like telling somebody price points and saying which one of these we want to pay. And this is harder to do digitally, but I'm a big believer in, if you say, okay, here's option A, here's what it looks like, here's what it feels like, that's this number. Here's option B, here's what it looks like, feels like, that's this number. Here's option C, which one do you pick? That they're really good and really insightful in giving you, and so when we're doing product dev, we're talking about what is the size, what are the ingredients, and the different things that will move it up and down on the spectrum in terms of cost. And so what I think customers tend to really struggle in a vacuum, where you just say, how much do you want to pay for this water bottle?
Right.
But instead, when you show them 3 different, here's 3 different looks, lids, whatever, and you just show them and you say, okay, which one of those are you picking off the shelf? They're like, oh, I'm going with B. They're very good at that, and that can be really helpful. So we'll do a lot of really broad stuff digitally, And then we'll usually pair that with smaller focus groups, which are more time consuming, but have helped us to get some qualitative insight and some of the more dialing in stuff. I mean, we really, our strategy has been to think very little in terms of marketing with how we do product dev. I guess we think a lot in terms of what are the channels that can work for us, where we can get the distribution. We think about, is there, clear market demand, but we don't, and this is probably a weakness even, but we just don't spend a lot of time thinking about, hey, where does the number have to be in order to pay Facebook and in order to make it all work? And maybe to some extent, that kind of counterintuitive way of thinking in today's climate has worked in our favor, because we don't spend very much on marketing and we do get a lot more organic walk-up demand, because we're creating products where it's what our customers are looking for, and where the price point, it's inherently attractive. I don't know. I mean, you guys, you can fill the Grand Canyon with everything you guys know about marketing funnels that I don't. But anyway, I think your thought process is really sound. I mean, probably, Dave, the reality is you're under investing. I mean, you've got natural advantages in terms of your cost basis to get something out there is very low. The upside, I mean, if you added 5 million in top line revenue, it would be dramatic for the financial performance of your company. And so I think from the outside, what I hear is I would build the internal capability to get a lot of shots on goal, to get 5, 10, 15 shots on goal. Because if you develop that capability and you go from 10 million top line to 20 million top line, you're going to be off to the races. And 20, it's counterintuitive, but it may be a lot easier to go from 20 to 100 than it was to go from 5 to 10.
Well, it's exactly what you're talking about. As the customer file grows, the investment risk of each corresponding product decreases. And so you can take more shots that can grow you more rapidly. Whereas there's not risk of ruin in being wrong at this point, but there's certainly impediment to growth risk. But Dave, to this point though, like, what do we think? You were talking about the production capacity. Let's just use the bar of shampoo, which I set aside whenever I think about that for a second. Let's just use it as a profile. Let's say we're like, yeah, great. What is the actual capital requirement to produce a meaningful batch, plus photography, plus marketing, plus, like, what are we talking about? Are we talking about $100,000? Are we talking about $200,000? Like, what do you think it is?
Tens of, because seriously, it's not even close.
You have to do it.
Yeah. Then to the point earlier, the 100x outcome at $5 million in revenue against such a low risk profile. It's like,
and the other thing here, Taylor, we can actually separate the test from the scale, because like we now have a contract manufacturer relationship where we can go to a contract manufacturer and say, okay, we're gonna run these at 10,000 quantities. What does that look like with you? And they go, okay, here's your pricing. And I can go, okay, let's go make 500 in-house. So we go make 500 in-house, and I'm buying what is essentially commercial cooking equipment. So like, even if I have to buy something, it's like, oh, okay, here's $750 of CapEx. Like, I'm not even sure we're going to expense $750 of cooking equipment. And then the rest is the formulation, where again, we actually currently have that resource in-house. That was, that's something that the founder that came in with did their own in-house formulation. The formulations, as far as the market are concerned, are relatively simple, but they are effective, and it's in the space for what our brand promises. So no, it's tens of thousands investment.
Important point here, just for everybody listening. It's come up a couple of times the last few days. You don't have to even hit good unit economics on a launch. It's not going to be material to the company's finances. And so I see our team sometimes get hung up on, they want to make sure the unit economics work and everything. And so they will overcomplicate the launch process of like, well, the MOQ on this is 2,000. I'm like, well, okay, let's pay through the nose. What's 500 cost? I'm fine. I don't care if it's $1 more expensive. Like, who cares? Like, we're just trying to prove the concept. And so like I use this analogy sometimes. I think it's really good for product dev also. Imagine Texas Hold'em, right? So Texas Hold'em is basically when you've got a great hand, you bet heavy to push everybody else out. And when you have a marginal to weak hand, you try to pay as little as you can to get more information. That's it. That's the entire game. That's product dev. how can I spend as little resources as possible to flip over the card? Because once I see the card, I know whether or not I want to put more resources behind it. And with what you're saying, Dave, it's like you can put so little money in to flip over the shampoo bar card. Why wouldn't you? Like, and why wouldn't you flip over 10 cards like that? That would be my piece of advice.
That's exactly, yeah, that seems exactly right. It's like this should become a quarterly part of our process, especially too. We have these other thing, which is like the burgeoning Amazon thing, which like is just a whole nother part of like demand capture. But it's sort of like, hey, let's throw up Aesop's Ave here and just work through them one by one and take a shot. You know, like that we know that there's a demand at a meaningful level for a lot of this stuff. We can make it at a low cost. Ready, set, go. So Dave,
that's exactly how
doing?
we started. We started with, where does Amazon have significant demand that we could launch into? We know there's a bunch of people already shopping for this stuff. Now that we obviously have a different perspective, we're not trying to draft off Amazon keywords, but yeah, like you guys are playing in product categories where there's millions of organic searches happening. And I can, for $10,000 or $15,000, I can throw my hat in the ring and see if something pops off.
Risk mitigation. Yeah. Awesome. Well, guys, this has been, I think, a really cool, I don't know that I've heard many conversations in this lane. So I'm hoping that it will be a thing for people and that they'll find useful. It's obviously for a subset of people, but I will say that I've gone through this experience over the last year. There is this transition that happens when you go from survival to a new responsibility of trying to figure out what to do with the money that's in your bank account. And it's a whole new evolution for founders, I think, to sort through, and it's an important one. So I think it'll be a useful thing in the market. And my last thing though is, Mike, you mentioned you've got a good 8-figure lump of cash sitting on the old balance sheet. I've got a way you could deploy that for about 15, 20-ish or so. Get Dave another human resource capture. Like, tell me why Bambu Earth isn't the right investment for Simple Model.
Well, I tried to put some money in Bambu Earth earlier this year. Maybe at some point that'll come on. I mean, what's interesting is we've been talking about this as you've got more cash than you can invest. I think acquisitions for the very first time have been something that are actually, they could actually make sense. The question starts to become, does it, even if the cash makes sense, are you creating organizational pull in different directions when the primary golden goose is the Simple Modern brand? And I think that's where we all want to get. And that's a whole different conversation that's really interesting. Like I've got cash in the bank, the company has cash, but 99% of my net worth is in this little mark, this little Simple Modern mark. And so that's the golden goose. And everybody needs to understand that that's where, the bright future comes from. So making decisions, and these are more qualitative, non-numeric decisions where you're trying to say, how do I maximize the value of the brand and the standing of a brand in people's minds? And then we could listen. I'll throw one more dynamic out. This is classic Mike. As founders, you're trying to maximize for quality of life, and quality of life is loosely correlated to your net worth and to your cash on hand. Okay, so I've got enough money at this point, so I will make some investment decisions that are not necessarily going to net me the highest quantitative return, numeric, like in terms of monetary terms, but they will net me the biggest return in terms of quality of life. And that's a whole, like, if we're talking about a public company where you're a CEO and you've got all these shareholders, like you're never making decisions that way. But if you're an owner operator like I am, then that makes a lot of sense, that it's like, hey, I could invest in that, but I don't want, this company came to me and, I'm going to triple my money on buying this thing, but I'm going to inherit all these problems and I'm going to be in this industry I don't love and I'm adding all this complexity in my life and it's not worth it. And so I get really interested in the ways that all those other dimensions stack on top of it. The best investors I know aren't just quantitative, but they're thinking about the much bigger picture. Yeah.
And I think it's funny, every question you answered, even Mike, there's a bent towards that. Like, what's the actual, is the product actually good? Do the customers enjoy it? Right. And it's like that a priori to anything financial tends to be a good foundation. So guys, this is awesome. I appreciate it. If anybody's made it this far, they've gotten some good, rich content, but where can people follow you to? Where's the spot? Is it Threads though? Or are we still following you guys on Twitter? What do you think?
It's Twitter.
I think I'm Team Twitter.
Team Twitter.
All right.
Yeah.
Okay. So what is it? Dave
That's
Rekuc
right.
and Mike Beckham, both normal names on there. Mike, you have an initial.
Yeah, I think it's Mike Beckham SM.
Yeah, there we go.
Which somebody pointed out it to me is like there's other ways that other things people associate with SM. So it's an unfortunate little Easter egg.
That's
there.
funny.
Awesome. I appreciate you guys both so much. Go forth, make great investments. I hope you all enjoyed that episode. Talk soon.